All right, let's peel back the layers. Today, we're embarking on a deep dive into the recent financial results of Tata Chemicals Limited. We're looking at their first quarter of fiscal year 2026, so that's the period ending June 30, 2025. And our mission, well, it's really to cut through all the numbers, the corporate jargon you find in the press releases, the investor calls, to really get to the most important nuggets of knowledge and insight for you. It's a great chance to see how a major global player like Tata Chemicals is navigating what feels like a very fluid global market right now.
It really is. And what jumps out at me from these results is, well, their resilience. Even with some pretty significant headwinds, they seem to be finding ways to manage quite well.
That's a great point. So let's maybe start with the big picture numbers, the consolidated ones, because there's this kind of initial contradiction, isn't there? Consolidated revenue from operations, okay, it came in at 3,719 crore rupees. Now that's actually down 2% compared to the same time last year. But then look at the consolidated EBITDA, that's earnings before interest, taxes, depreciation, amortization, basically, operational profit. That was 649 crore, and that's up quite a bit from 574 crore last year. And the consolidated profit after tax before you account for non-controlling interests, that really jumped 316 crore compared to just 175 crore. So yeah, revenue down, but profits are way up. How does that work? What's the secret sauce there?
Yeah, that's a sharp observation. It really speaks to their strategic agility, I think. The main reason for the revenue dip, it was mostly because they stopped operations at Lostock in the UK. They basically closed down a unit that wasn't viable. So naturally less volume, less revenue overall. But the boost in EBITDA and PAT, the profit figures, that's largely down to, well, lower costs and really strong operating performance everywhere else. And this happened even though they were getting less money per unit sold, lower realizations because of pricing pressure pretty much everywhere. It shows they can kind of decouple profit from just top line growth, which is quite impressive discipline. And just to contrast that, look at their India standalone numbers for Q1. Very different story. Revenue up 12%, 1,169 crore. EBITDA up 15% to 270 crore. And PAT jumped 20% to 307 crore. So yeah, India's domestic performance, really quite robust.
Okay, that makes sense. Cutting the less profitable parts helps the bottom line even if revenue dips. Strategic. But despite that strength in India, management is still talking about, fluid market conditions globally. Demand may be flat near term. They mentioned tariffs, trading issues. So what's really going on with global demand? Is it weak everywhere?
Well, the nuance is key here. Overall global demand might be flat, yes, but demand in India and China actually quite stable. And we're seeing pretty robust demand in other parts of Asia, outside China and India, and in the Americas if you exclude the U.S. So it's definitely not a uniform picture. The demand-supply balance on paper looks balanced, but those tariff uncertainties, they do hang over the market. Now, the critical point, especially for their main business, soda ash, that market is still oversupplied globally. Inventory levels are high. That Sinai inventory benchmark, it's still high at about 1.8 million tons. And that absolutely keeps pricing, well, range-bound, puts a lid on it.
Right, so that inventory overhang is keeping prices down in the short term. But if we look further out, the longer term for soda ash, is there anything that could change this supply-demand dynamic?
That's a really good question. Because while the short term is challenging, the medium and long-term outlook does look quite positive. This is being driven by some big sustainability trends, actually. Think about the growth in solar PV, electric vehicles. Both need soda ash. And the good news, maybe, is that prices seem to have largely bottomed out now. We're only seeing declines of maybe $3 to $5, perhaps $10 in a few spots. The general feeling is that prices will probably stay in this sort of range for the next, say, 6 to 9 months. So probably no big drops from here, which gives some stability, even if it's at a lower level.
Interesting. So sustainability trends could be a long-term driver. Okay. With that global picture set, let's maybe zoom back in. How are these strategies playing out on the ground, region by region? Let's start with India again. We saw the strong numbers. What was behind that performance?
India was, yeah, very strong. It was driven by higher volumes, first off, and some significant operational efficiencies they put in place. They did get slightly lower prices for soda ash and bicarb, the realizations, but that was mostly offset because they produced more higher throughput and had lower variable costs. It really shows their strategy of excel in operations through innovation, digitization, and people actually working, getting more efficient.
Okay, solid performance in India. Now let's look at the U.S. You mentioned export sales and prices were a bit lower there, partly because a big shipment got pushed to Q2. But interestingly, profitability improved in the US. How did they manage that with lower sales?
Yeah, the U.S. improvement, despite lower volume, was mainly down to a favorable mix of sales. They sold a higher proportion domestically within the U.S., and domestic sales usually have, better net realizations, better margins. Plus, they managed to lower their fixed costs there, too. It's worth keeping in mind, though, that this mix might sort of normalize in Q2, so we could see a slight dip in the U.S. performance quarter on quarter, maybe.
Right, so the mix effect might not repeat every quarter. Understood. Okay, from the US, let's go across to the UK. We know about the lost stock closure, but what's the plan for the rest of their UK business? You mentioned other parts did better financially.
Yeah, the goal for the UK now is ambitious. They want to get the remaining business to at least break even, maybe zero losses at the PAT level by the end of this fiscal year. So aiming for Q3 or Q4. And they have two key things driving that. First, they're starting their own CO2 production that reduces their reliance on buying CO2 in the market, gives them more cost control. Second, they're commissioning a pharmaceutical-grade salt plant. They're hoping for customer qualification in the second half of the year. And that's important because pharma-grade salt is a much higher margin product. It fits perfectly with their strategy of broadening into specialties.
Moving into higher value products. Makes sense. And Kenya, lower volume, some margin pressure from export mix, but that should normalize. And they've got a new 50 kiloton expansion there just coming online now.
That's right. Kenya saw a bit lower volume, and the margin dip was because they exported more to Southeast Asia, which has different margins than domestic African sales.
Yeah.
Yeah, expected to normalize. And the 50 kiloton expansion plant is commissioned. It's in trial runs now and should be delivering product properly in Q2. So that's new capacity coming on stream.
Okay. And we have to mention Rallis India, the crop protection subsidiary. Wow, 22% overall growth, 9% volume, 13% price, EBITDA margin at 16%, and PAT growth of 100%. That's huge.
It really is standout performance from Rallis. And it's not just a one-off good quarter. It really highlights how their diversified portfolio helps them. When the core soda ash market is tough, crop protection provides a really strong buffer, a high-growth engine. It shows the strategy of expanding the core and broadening the specialty portfolio is, well, working. And, beyond just the operations, their whole sustainability push, Project Elangana, is having tangible effects too. You see in their ESG rating from CRISIL, which is adequate. You see it in things like the biogenic fuel trials, trying cleaner energy sources. Plus that new 5 milliW solar plant in Magadi, the electric calciner there, it all adds up. And things like their water harvesting, the whale shark rescues, it shows real commitment.
Right, sustainability isn't just talk, it's tied to operations. Good point. Okay, let's talk costs, specifically power and fuel. Huge part of their expense. The report shows a big drop this quarter, 453 crore versus 593 crore last quarter, attributed to lower coal and gas prices and that lost stock closure. Is this lower cost level sustainable, do they think?
Yes. According to management, this lower level of power and fuel cost, around 453 crore, is considered a sustainable number going forward. And that's really critical because it supports their big financial target for the full year, FY26. Remember, they're aiming for a structural EBITDA improvement of 600 crore rupees. That's split three ways. 200 crore from shutting down lost stock, 200 crore from new projects coming online, and another 200 crore from just ongoing cost-saving efforts. What's also impressive is how they've managed profitability. Even though market prices for their products fell, their input costs, the variable costs, fell by a similar amount, so it kind of offset, helping protect margins.
Okay, so cost control is a major lever they're pulling successfully. What about spending? Capital expenditure, CapEx, are they still investing heavily?
Well, last year was definitely the peak of their recent CapEx cycle. Big spending then. This year, the plan is more focused on operational CapEx maintenance, keeping things running smoothly. Around 1,000 crore globally. There isn't much major growth CapEx left over from last year's big projects that still needs paying for. Now, on specific expansion projects, there are some updates. The big US soda ash expansion. Design work is done, environmental approvals are in hand, but it's on pause. They're waiting for the market conditions to become clearer given the oversupply. Could be paused for a couple of quarters, maybe even a year. It shows discipline, not just building, regardless. In India, the soda ash expansion 3.2 lakh tons. That's happening in 2 steps. The focus there is on something called dewatering at low cost. Basically making the water removal process more efficient using existing plant capabilities. Saves energy, better for environment. We should get more details by Q3. For the UK sodium bicarbonate expansion, the 1.8 lakh tons, design work is ongoing. But the priority this year is just making sure the existing 80,000-ton unit runs well after its reconfiguration.
And this specialty silica project, 0.6 lakh tons. The first half of that is already being built. Execution is underway. Oh, and one other small boost for the quarter. The India business got a 75 crore rupee income tax refund relating to an old case that gave a nice one-time bump to the payday figure.
Okay, so pausing some big spends, focusing on efficiency in others, and moving ahead with specialties seems prudent. So, what does all this mean for you, the listener, trying to make sense of this? It sounds like management is really stressing. The global soda ash problem isn't demand collapsing. Demand is actually growing, especially in India. The problem is purely supply. Too much capacity out there, some of it maybe not very efficient or viable. And it seems Tata Chemicals isn't alone in reacting. You mentioned another European player closing capacity, maybe a Chinese one considering it too. The market might be slowly correcting itself.
Exactly. And that leads to another key point, how different markets actually react to pricing. There's not one size fits all. U.S. domestic prices, mostly set on annual contracts.
Yeah.
So stable through the year. India pricing is quarterly, based on import parity, what it costs to import, plus usually a small premium. The U.K. also uses annual contracts. Stable pricing there, too. Now, exports from Kenya and the U.S. to Southeast Asia, mostly quarterly pricing. U.S. sales to Latin America, mostly annual. So it's really only that Southeast Asian market that moves closely in sync with Chinese export prices because, well, they don't have their own producers. This variation means global oversupply doesn't hit everyone equally or at the same time.
Fascinating how fragmented the pricing mechanisms are. And within this oversupplied market, who holds the advantage competitively?
Well, the natural soda ash producers definitely have an edge. Think places like Mongolia, producing huge volumes. Their variable costs are much lower. That means they can afford to ship at long distances, absorbing freight costs of maybe $30 to $50 a ton, and still compete. Synthetic producers, with higher variable costs, they tend to be more focused on their domestic markets or very nearby regions. But even with all this market fluidity, management sounds pretty confident about hitting that 600 crore EBITDA improvement for FY26. They're basically saying, look, even if prices soften a bit more, maybe costing them 50 or 60 crore on the top line, their cost reduction efforts should largely make up for it. And just looking at the health metrics from the report for Q1, operating margin for continuing operations was solid at 9.92%, net profit margin 8.5%. Net debt was under 5,000 crore at 4,972 crore. Seems manageable.
Okay, so pulling it all together. Despite the tricky global market and those pricing headwinds, Tata Chemicals delivered a pretty robust Q1, driven largely by tight cost control, smart operational moves like closing loss stock. Their focus on efficiency, on sustainability, on targeted growth in specialties, and in strong markets like India. It really paints a picture of a company playing the long game, navigating the current challenges while building for the future.
It really does. And this raises, I think, an important question for the future. Considering this ongoing oversupply in soda ash, but also Tata Chemicals' clear strategic shift towards specialties and operational excellence. How might this blend this mix of traditional heavy industry with forward-looking sustainability and higher value products? How might that actually redefine value creation? Not just for them, but maybe for the whole chemical sector in the years ahead.
Redefining value in the chemical sector. Definitely something to mull over as you continue your own deep dive into what keeps the world's industries humming.